As we're saying, Stanley Fischer, the latest U.S. Fed official to signal an interest rate hike, is still on the table this year. For more on this and how much credence we can give to these comments, we're joined by Path Trading Partners, Bob Iaccino. Bob, great to see you.
Good to see you, Greg. How are you?
All right, I'm great. I want to get your thoughts on this. And when they told me I was going to be speaking with Bob Iaccino, what do you think about this jawboning we're getting from the Fed officials? We've had days of it now. Is the market actually paying attention? And should we be afraid about a September rate hike?
Well, I'm not sure who has less credibility right now when they jawbone, the U.S. Fed or OPEC. We have heard about this second rate hike for 16 months, since before the first rate hike. We've heard over and over again, controlled, measured, couple of rate hikes, maybe in through 2017. When you look at the dot plots, it certainly implied that there was going to be more than the December one and done that we saw. And the Fed continually came up with, I don't want to call them excuses, but reasons to hold that rate hike back. I think when Janet Yellen was put in that chair, I think we all understood it was going to be a more dovish Fed, and that's what we've gotten essentially. I'm not sitting here telling you that the U.S. economy is showing just tremendous strength, but the data has been moving in the direction the Fed wants it to for quite a long time. And along with that movement, we've seen comments about a rate hike is on the table, a rate hike is on the table. So, Greg, I don't know when we start to take it seriously, but it doesn't seem to be today.
It seems to be a very hard place for a trader to be because the Fed has enough excuses not to hike, and yet every time a data point comes out with the strength of the U.S. economy, you do see people trade off of it. It leaves you in a bit of a tough spot, trying to guess their minds.
Well, you know what I don't like right now is I don't know what excuse they have left other than the election, and the election politicizes them. We don't have a long and storied history of rate hikes going into a presidential election. We just don't. I would argue, if I were at that table, that this particular election is so different that I don't think a Fed rate hike and a subsequent collapse of the stock market, which I don't think would happen, by the way. But if it did, I don't think it would affect the election that much, because I don't think this election is being played out on asset inflation. Perhaps the general economy, which I think everyone understands, is pretty much detached from the stock market at this point. But I don't think it matters. And if they say that they can't hike, which they won't, but if they say they can't hike because of the presidential election, that'll look really, really bad. So I don't know what they have left. I guess we'll hear on Friday.
Yeah, I get some indication from Janet Yellen. We're entering the last weeks of summer here, the real dog days. I assume that after Labor Day, everyone gets back to their desks. We do have the election. We seem to have a Fed on hold. What should traders be looking for apart from those two things in terms of guiding their strategy?
Well, a couple of things. It seems like we've gotten a little bit of the M&A bug getting started, so I'd like to see that increase in terms of the effect of cash being put to use, at least from asset acquisition. We haven't seen a lot of capital spending. I'd like to see that. I'd like to see more capital spending come through. And I think that's the only place where the presidential election might matter, because you get some certainty and perhaps you get an idea of what. I don't run a big corporation. I run a prop trading group, so we don't look at it that way. But from a capital spending perspective, I'd like to see that start to creep up. If you don't see that, I think you have to worry a little bit. But then the most important thing is obviously the direction of the Fed. I mean, are they going to go into 2017 saying, okay, now things are solid, we've got everything out of the way, and we can actually start to put rates where they maybe should be given the amount of growth we have? Again, we don't have torrid growth, but 1.5%, 2% still growth.
Now, Bob, I understand you like some retail names, Dick's Sporting Goods, Lulu, but we had that retail disappointment. Does that give you any concern when you have that kind of investing strategy?
Well, here's the thing. Two of these are trades for me. Of the three stocks that I like for today, two of them are trades, and one of those trades is Lululemon. Lulu's got earnings coming out September 1st. I did not believe for quite a long time in the athleisure trend, and I've given in completely. I've got tennis shoes on down here that you can't see. I'm not wearing yoga pants, but I do have tennis shoes on. But I mean, it's just everywhere, and I think that they're the best of the best, the class name, and they're kind of a luxury brand that a lot of people can afford in their day-to-day life. So I think Lulu's going to do well in their earnings, and I think they're going to spike to new highs. I'm looking for about 83 in that stock. Dick's Sporting Goods is really taking advantage of the Sports Authority closing down stores, same-store sales in the area where Sports Authority seems to be creeping up. And I think that's a real name, again, with the athleisure play, because they sell more than just yoga pants. If you can't afford Lululemon, you go to Dick's Sporting Goods. And again, I have tennis shoes on down here, and guess where I bought them? So I think they're going to take advantage of that over time. Retail's been terrible, But bricks and mortar has been terrible, which both of those are, but they both have a really strong online presence as well.
We only got about 30 seconds left, but I know that your third pick is Intel. What do you like about that? Hardware is not a great place to be.
Yeah, but Intel moving really strongly into artificial intelligence, and I think with virtual reality and things, that's a big growth area. It's going to be like the cloud, where there's room for a lot of players, and I think Intel's going to participate pretty strongly there.
All right, Bob, always a pleasure speaking with you.
Thanks, Greg.
That was Bob Iaccino, co-founder and chief market strategist at Path Trading Partners.